I don't know, maybe not. You consider that 11th hour deal reached by lawmakers designed to avoid default, but it does little to tackle the nation's long-term fiscal problems. And it's not the big plan that anyone had in mind. Way short, including S&P, which has said $4 trillion or you get a downgrade. That's just one of the things that we're going to be speaking with Ralph Schlosstein about. He was hoping as well for that $4 trillion deal. That is T. He is president and CEO of Evercore Partners. He is joining Adam and I in the newsroom for this hour. Ralph, thanks so much for coming in. Glad to have you with us. Confidence, CEOs, big leaders, you hear from everybody on this. Has this debt wrangling held back business as usual as you see it?
Not yet. And I think it remains to be seen the longer-term impact that it has on the real economy, because that is ultimately what will affect business confidence and CEO confidence. I think the early indications are that this has caused consumers to pull back a little bit, although we can't really judge that until we see a couple of months of data.
And arguably, I suppose consumers are not holding back because of the debt worries. They're holding back because they don't have jobs.
Well, they're holding back because we have a whole range of clouds over their existence. The most consequential, of course, is the slow rate of recovery and the lack of jobs in our economy. The second, and very important, is that consumers, despite the fact that they have been paying down debt over the last 2+ years, still have an extraordinarily high level of debt relative to their incomes.
And of course, there have been a number of CEOs in this earnings season who have come on and said, given the uncertainty, we're not investing in plant and equipment as we otherwise would.
Right. Well, the sad thing here is that when CEOs talk about uncertainty, what they're really talking about is they don't see the certain demand for their products ahead. Unfortunately,
or they don't want to say that.
They don't want to say that. But unfortunately, this debt ceiling, crisis, because we are literally at the last day, it will get resolved. Everybody expected it to be resolved. But this was a self-inflicted wound. And an economy that's already recovering too slowly to generate jobs, and that has the additional uncertainty and overhang of Europe, it's a shame that we did this.
Bill Gross from PIMCO saying as well, the compromise reached by Congress won't make a significant dent. I'm just reading off of a newsletter that he sent out in the U.S. deficit, which actually we've been talking about ourselves. But he also says U.S. has nearly unfathomable future liabilities. What do you make of that?
Well, I think if you look ahead and project current policy as it is today and the demographic trends, you can get pretty concerned about the future of the country. These things, though, with focused action that addresses our long-term spending and revenue imbalances, can be brought back into line. I think the one thing that people don't focus on as much as we should is that we have an immutable demographic challenge for this country. The baby boom is getting older. The ratio of non-workers to workers is going up. That is happening today in Japan. We can see it on the horizon in this country. One thing we know is how many 65-year-olds and older there will be in 2020 and beyond. Well, I think the unfortunate thing is that we're now in a position where we're on credit watch, which was a self-inflicted wound. We're on credit watch not because of our short-term or intermediate-term financial problems. We're on credit watch because of management, which this process was not pretty to watch. So I think that's still something that we have to watch carefully. It's on the horizon. I do think the challenging problem we have here is that even after this bipartisan committee reports at the end of this year and it's acted on at the end of this year, we're still a long way from addressing our fundamental long-term deficit imbalances. Even at its best, the committee will add another $1.5 trillion to a roughly $900 billion that has been done so far. That's roughly half of what we really need to get done to put America on a more sound fiscal course so that our deficits are an appropriate percentage of our GDP.
Evercore Partners, Ralph, we've got the vote in the Senate coming up in a few hours. Any chance this doesn't go through?
I don't think so.
And does it improve the situation at all?
I think the market has already discounted passage of this legislation, and I think the market is clearly focused on the economy, and
Which is not good.
which is not
But
good.
that said, banks, we're talking about Barclays laying off tons of people, HSBC as well. Evercore is hiring.
Yeah, I think the process of job creation, if one looks back over many decades, job creation in our economy has been focused more on smaller and medium-sized businesses.
So that's where you see your advantage then in being able to get the talent that you want.
Well, we're very fortunate. We're on a pretty good roll right now. We finished number 6 in M&A in the U.S. in the first 6 months of this year, ahead of some firms that have 25, 30 times as many bankers as we do. We've been involved in a number of large transactions in the first 7 months of the year. So we're viewed today as a very attractive place to work given the disconcert in other parts of the financial industry.
Ralph, thanks so much for joining us for this hour. We've been glad to have you.